All right, so let's review the accounting rate of return, or otherwise known as ARR. So that measures the average accounting rate of return over the asset's life. So note that ARR uses operating income, which is revenues minus operating expenses. And if you're given annual cash flows, you must subtract depreciation expense in order to get operating income. Recall that operating income is based on accrual accounting. Therefore, any non-cash expenses such as depreciation expense must be subtracted from the asset's net cash inflows to arrive at its operating income. And you can see the formula here. We just take the average annual operating income from the asset divided by the original investment. Or if we are given the annual cash flows, you have to subtract that annual depreciation expense in order to arrive at the IRR. So here's a brief little example. And let's assume that we are buying some new production equipment that costs $240,000, but it has an unequal net cash inflows over the life and a $30,000 residual value at the end of its life. So the production equipment differs from the other two investments in two respects. It has unequal net cash inflows during its life, and it has a $30,000 residual value at the end of its life. The production equipment will generate net cash inflows, you can see here, $100,000 in year 1, $80,000 in year 2, $50,000 in years 3 through 5, and $30,000 in year 6 when it's sold at the end of its life. So the first thing we need to do is to calculate the production's equipment average annual cash flows, which would be all of the cash flows added together and divided by the 6-year useful life. We also need to calculate the depreciation. So that gave us $60,000 per year average cash flow. And then to calculate depreciation, if you remember back to the beginning of your financial accounting class, you take the cost minus any residual value divided by useful life. That's straight line depreciation. So in this case, it comes out to $35,000 depreciation expense. So then we can go ahead and calculate the ARR. And the way that we do that will be to take the average net cash inflow of $60,000, and then we subtract the depreciation, which is $35,000, divided by the cash outflow when we initially purchased the equipment during the initial investment, and that gives us 10.42%. So the higher the ARR, the more attractive the investment would be. So the decision rule here is if the expected accounting rate of return exceeds the required rate of return, then we do the investment. If it doesn't exceed the required rate of return, then we would not do the investment.